Have you ever paused to ponder about investing, but didn't know where to start? Well, you're certainly not alone. In fact, you're in the majority. A vast number of individuals have always wanted to invest, but feel utterly bewildered by the sheer volume of information available out there. It's almost as if you're standing on the edge of a labyrinth, hesitant to step in. You look in, and all you see is a confusing maze of numbers, charts, and terminologies that you don't understand. Isn't it? The fear of taking a wrong step of losing money is a common deterrent. But here is the thing. Investments don't have to be complicated or intimidating. A well-built portfolio is about making your money work for you while you sleep, growing your wealth, and providing a buffer for the future. And the good news is, it's achievable, even if you're starting from scratch. Think of it as learning a new language. It can seem daunting at first, but once you start understanding basics, it becomes a lot more doable. You don't need to be a Wall Street wizard to invest wisely. All it takes is a little bit of time, patience, and the right guidance to help you navigate the tricky waters. So let's take this journey together and demystify the world of investing step by step. First off, what is investing? It's a question asked by many and understood by few. To simplify it, investing is all about utilizing your hard-earned money with the aim of amplifying it over time. Now, this amplification isn't magical. It happens when you strategically put your money into various financial avenues. These avenues can be diverse. They can range from financial schemes to shares, from property to even developing a commercial venture. Each avenue has its own set of advantages and risks. When we talk about financial schemes, we're referring to fixed deposits, mutual funds, bonds, etc. These are generally considered to be safer options that provide a steady return on investment over a period of time. Then we have shares. Investing in shares means buying a part of a company. The returns from shares can be extremely high, but it also means a higher risk. It's like a roller coaster ride. The highs can be exhilarating, but the lows can be equally daunting. Investing in property or real estate is another popular avenue. It involves purchasing a property and then earning from it through rents, or by selling it at a higher price in the future. Finally, using money to develop a commercial venture means creating a business or a startup. So, investing isn't just about throwing your money into something and hoping for the best. It's about understanding different avenues, analyzing their risks and rewards, and then choosing the best option for your financial goals. Simply put, investing means to expend money with the expectation of achieving a profit or material result by putting it into financial schemes, shares, or property, or by using it to develop a commercial venture. Now, on to the first step, setting your financial goals. You might be wondering, why is this step so crucial? Well, it forms the very foundation of your investment journey. It's like setting the destination on your GPS before you start driving. Without knowing where you're headed, you might end up stumbling around, lost in the labyrinth of what exactly does setting your financial goals entail. It involves a thorough self-evaluation, a deep dive into your desires, needs, and future plans. Are you saving up for a new house? A place you can call your very own? A sanctuary that provides a sense of security and achievement? Or perhaps you're looking towards a stable and comfortable retirement, a time when you can sit back, relax, and enjoy the fruits of your years of hard work. Maybe you're a parent, and heart is set on providing your child with the best education, a sturdy platform for them to launch their dreams from. Each of these goals requires a different investment strategy, a unique approach. You see, investing isn't a one-size-fits-all solution. It's a journey tailored to meet your specific needs and aspirations. Hence, having a clear goal mind is not just beneficial, it's critical. It's your guiding light, your North Star in the vast universe of investing. It gives your journey a sense of direction and purpose, enabling you to make informed, strategic decisions that align with your objectives. And with this clear goal in mind, you can navigate the often overwhelming world of investing. This vision becomes your compass, guiding your every investment decision. The second step is to comprehend your risk tolerance. This is a fundamental aspect of investment, as all investment avenues, irrespective of their nature, come with some level of risk. This principle is universal, and understanding it is crucial. Remember, the world of investing is not a gamble, it's a calculated risk. It's a commonly accepted notion that with higher potential returns, the risk associated also increases. Is a rule of thumb in investing. Mutual funds, stocks, bonds, or real estate. Wherever you are planning to invest, this rule will follow. Now let's pause and introspect. Ask yourself, can I bear this risk? This question forms the crux of your risk tolerance. The risk varies from person to person. Some may have a higher threshold while others might have a lower one. And that's perfectly fine. It's all about whether you are okay with the possibility of losing money for the chance at higher returns. This is an important question that you need to answer honestly. It's about your hard-earned money, and your decisions will shape its future. On the contrary, there are safe, reliable, and predictable investments that don't promise a very high return, but are less volatile. It's the tortoise and the hare in the investment world, and it all boils down to your personal preferences. Or would you prefer a safer, more predictable investment? Your answer will carve your investment path, a path that suits your financial goals and risk tolerance. Step 3. Research different investment options. This is a crucial stage in your financial journey because it's about delving into the heart of the matter, the different investment options. There's a wide and diverse array of choices available for you to explore, and each carries its unique characteristics, advantages, and disadvantages. These options represent the marketplace, a vast and dynamic ecosystem that offers varied forms of investments, from the traditional to the most innovative. For instance, there are stocks, a form of investment that signifies ownership in a corporation and represents a claim on part of the company's assets and earnings. Bonds are another investment option, which are essentially a loan from an investor to a borrower. Bonds are typically issued by corporations and governments to finance projects and operations. You might also want to consider mutual funds, pooled investment vehicles, that collect money from many investors to purchase securities like stocks and bonds. They offer diversification and professional management, which can be suitable for investors who prefer a hands-off approach. Real estate hand represents a tangible asset class that involves investment in property. It offers potential income through renting or reselling and can provide a hedge against inflation. Each investment option has its own risk and return profile, which vary depending on a host of factors including market economic cycle and personal risk tolerance. These options aren't one-size-fits-all. What works for one person may not work for you, and vice versa. That's why it is critical to take the time to understand these before making a decision. The more informed you are about the different investment options, the better equipped you will be to make sound financial decisions that align with your personal goals and risk tolerance. Next, the 4th step, diversify your investments. This principle of investment, often stated colloquially as "don't put all your eggs in one basket," is of paramount importance. It essentially means that instead of focusing all your capital and resources into one particular investment or asset class, it's best to distribute them across various domains. In the world of investments, this could mean exploring a mix of stocks, bonds, mutual funds, real estate, and more. The broader your investment portfolio, the better equipped you are to face market volatility. This approach provides a safety net against any sudden decline in any one particular sector. What really makes diversification such a valuable strategy is its potential to balance risk and reward. Even if one particular investment doesn't perform as expected, the success of other investments can help to offset the loss. It's about optimizing your potential for high returns, while also minimizing the potential risks involved. Different investors may choose different asset classes based on their risk tolerance, investment goals, and financial situation. There's no one-size-fits-all model when it comes to diversification, but the idea is to spread out your investments to cover as many bases as possible. By spreading your investments across different asset classes, you can potentially reduce risk and increase returns. 5th step, consider the costs. Investing isn't free. There are fees and taxes that can eat into your returns. Be aware of these costs and factor them into your investment decisions. Finally, the 6th step, keep learning. The world of investing is constantly changing. Stay informed, keep up with market trends, and adjust your investment strategy as needed. To summarize, start by setting your financial goals and understanding your risk tolerance. Research different investment options and diversify your investments. Be aware of the costs associated with investing and keep learning to stay ahead of the game. Investing can be a powerful tool to help you achieve your financial goals. But remember, it's not a get-rich-quick scheme. It requires patience, discipline, and a willingness to take on some risk. But with careful planning and a solid strategy, you can make your money work for you. And who wouldn't want that?